the original sponsor of the talk. Why? It's because I know David Elkin, who's the managing director of GreenWorld Capital, who's put the program together for about 3 years. I first met him when he did a similar program for our think tanks and civil society program. And being that I spend a lot of time in Asia, mostly Korea, but I've been to China about 7 times. I had to go see him, and he was a remarkable man, a lot of energy, a lot of similar interests. So he called again and said, hey, I want to do something on Chinese foreign direct investment in the United States. I was immediately interested, in part because I teach political risk analysis, and I'm always picking on the Chinese in that class, because they've been remarkably both victims and abusers of political risk when it comes to foreign direct investment, both in China, and they've encountered it in big time here in the United States. So I have an interest in seeing that improve in the future. I want to thank Jacques Delisle of the Center for East Asian Studies, who agreed to sponsor as well, the China Global Connection, Wharton Energy Club, the Penn International Students for Sustainability, Penn Engineers Without Borders, a fabulous organization on this campus, and Oikos, the Penn Students for Sustainable Economic Management, who all have signed on to bring this illustrious panel, very, very distinguished panel together to discuss opportunities for Chinese foreign direct investment, not just in the United States, but in energy and clean tech. 3 years ago, people would yawn if you said alternative energy. It's astounding that, from my point of view, this is the future. We have, as those of you in finance know, there are billion-dollar funds, like climate change capital, that all they do is clean tech, alternative energy investment. I think it's the future. All we hear in the press in the United States is about Chinese monopolies of solar panels. We hear about government investment in Solyndra and how terrible that was. And what we're missing in the big picture is some really dynamic good things are happening today. And we'd love to see Chinese investment in alternative energy in the United States. And I believe David's put together a panel that will discuss both the opportunities and challenges in doing that. To lead off the program, we are going to have a welcome from Mayor Nutter of Philadelphia. Who has just returned from China, where I believe he went in December. Right? So thank you for joining us. And David, thank you for putting together this great panel. Mayor Nutter.
Hi, I'm Philadelphia Mayor Mike Nutter, President of the U.S. Conference of Mayors. It is certainly my pleasure to welcome the distinguished panelists and attendees to GreenWorld Capital Symposium focused on Chinese investment in the U.S. renewable energy and clean technology market. In December of 2012, I had the great honor and pleasure of visiting Beijing and Tianjin, Philadelphia's sister city in China. While there, I met with Beijing's Mayor Wang and Tianjin's Mayor Huang. In Beijing, Mayor Wang and I participated in a 2-day conference on urban sustainability called Cities of the Future, where we heard a great deal about China's work in this area. One of my goals as mayor is to make Philadelphia the greenest city in the United States. And I know that my good friend, Mayor Bloomberg in New York, shares my passion for sustainability, as do all of our Chinese counterparts. On a national level, the use of renewable energy and clean technologies are of critical importance in both the United States and China if we are to provide our citizens and future generations with clean air, clean water, and a healthy environment. To accomplish our sustainability goals, we must stimulate a robust private sector marketplace that encourages sustained cross-border dialogue among investors and operating companies in both countries. Much remains to be done, but I am fully confident in our abilities. It is so fitting that these symposia are being held at Columbia University and the University of Pennsylvania, 2 of the most prestigious higher learning institutions in the world. I applaud the efforts of GreenWorld Capital in organizing these events and facilitating cross-border investment activity in this critically important sector. I can tell you that Philadelphia is open for business, and we welcome Chinese investment in our city. I wish everyone an enjoyable and informative discussion. Thank you.
I'm Terry Cook of the China Partnership of Greater Philadelphia. I had the great privilege to accompany Mayor Nutter to China in December. And as my introduction to quite an important panel this evening, I'd just like to share 3 observations. Number one, it takes at this point a governor or a mayor to hold up the banner to create the investment connections that are ready to happen right now. The U.S. government created a framework of cooperation back in 2009, 2010. I've written with the Wilson Center a small book on that subject, but what's happened with the political transition in our 2 countries over the last 6 months is that the action is really shifting now down to real decision makers who can take advantage of the framework that the 2 national governments created. Mayor Nutter was there in December. California Governor Jerry Brown is just wrapping up a trip to China right now. The second observation is that because of structural differences between the United States and China, there hasn't been the natural receptor site link up between our 2 economies that make the investment flows happen easily. I mean, all you have to do is look at the organization of a mayor's office in China, where there is a whole phalanx of specialized people in different industry areas. U.S. city mayoral offices just aren't organized like that. But we have Sam here, and under-resourced compared to his Chinese counterparts. He's doing a great job, as are colleagues like Dwayne Bum and Alan Greenberger in helping align the government-to-government, city-to-city level. Because after all, it's the mayors who who shape utilities, the built environment, transportation systems. They're extremely important decision makers in this process. And my group, the China Partnership, a nonprofit that is specifically designed as a platform where universities, companies, local government, and NGOs can all work together to get our region plugged into the U.S.-China 10-year cooperation in energy and environment. And the third and last observation is that we now have in the private sector the emergence of organizations that have recognized the opportunity and are stepping up to create the network of relationships for basically this connection of money to flow through the global system. GreenWorld Capital and David have done a great job in terms of positioning themselves with investment services or with merchant banking type involvement. A law firm that joined Mayor Nutter in our delegation, White & Williams, now has a strategic alliance partner in our sister city of Tianjin. The network of business-to-business relationships to support this opportunity is falling into place. The highlight of the Asia Society's report that they delivered to Governor Brown before he went to China. I'll just read the very first sentence, but it segs very well into the topic of tonight's symposium. Quote, "The era of significant growth in outward foreign direct investment from China to advanced market economies has begun." This is a whole report, and GreenWorld Capital has done a similarly good report, and it's tied to our region. And then finally, one other factor that makes it very promising, there's a whole generation of young people who are now understanding the realities in both markets and have applied their energy and their intellect and are going to really be fueling the ability of our regions to cross-connect and deal with urban sustainability issues and a cleaner environment in the years ahead. So thank you very much, and with that, David Elkin.
Thanks, Terry. Terry, I hope you'll join the panel for the Q&A. Yes, this is. Chuan, does the left button advance the slides? How do I? Got it. Okay. Good evening, and thank you all for attending tonight's program. I'd like to thank Dr. Frank Planton and the International Relations Program, along with our other primary sponsors, Global China Connection and the Center for East Asian Studies, for sponsoring tonight's program. I'd like to thank the Global China Connection for a lovely dinner that all the speakers tonight had over at the Inn at Penn just before tonight's event. I'd also like to thank our co-sponsors, the Wharton Energy Club, the Wharton China Business Society, Penn Oikos, the Penn International Sustainability Association, and Penn Engineers Without Borders for their support. I'd like to thank Luke Zhou, Min Lin, and Lydia Liu for their assistance in making tonight's program possible, and special thanks to Chuan Chen, who was responsible for planning and for the planning and execution of so many aspects of the event. Chuan, you've been outstanding.
Thank you, David.
I'd like to thank our distinguished panelists, Dr. Derek Scissors, Senior Research Fellow at the Asia Studies Center of the Heritage Foundation, Dr. Marshall Meyer, Saiwan Tsai Professor in Management and Sociology at the Wharton School of the University of Pennsylvania, and Joe Salvatore, Research Analyst at Bloomberg New Energy Finance, for participating in tonight's program. Dr. Meyer and Dr. Scissors have been writing and speaking about the economic development of China since the days when no one cared. Now everyone cares. And Bloomberg New Energy Finance is, by far, the global leader in assembling, analyzing, and reporting information and data on global clean energy and renewable technologies. Joe Salvatore heads Bloomberg's research in this area out of New York City. We're very fortunate to have him with us. Tonight's event and last night's event at Columbia University that was alluded to by Mayor Nutter were planned following GreenWorld Capital's release last month of a report called The Green Dragon Moves West: Opportunities for China, FDI, and U.S. Renewable Energy and Clean Technology. Copies of the report in both Mandarin and English are available on our website. We greatly appreciate Derek Scissors' review and commenting on the report before it was published. Of course, before the Green Dragon could move west, he had to be green. A development that was reported so presciently in a Knowledge at Wharton article in 2009 called The Dragon Turns Green, China's Manufacturing Adapts to a New Era. I hope you enjoyed tonight's program. A Q&A will follow the presentation. The above chart reflects the growth in China's annual outbound FDI flows from 2005 to 2012. I'll make a distinction here between FDI flow, which reflects annual investment amounts, and FDI stock, which we'll talk about in a minute, which reflects the cumulative current investment. The two bars depict data independently reported by China's Ministry of Commerce and by the Heritage Foundation. In 2012, China's outbound FDI flow approached $80 billion. That amount placed China as the 5th largest provider of FDI in the world, according to the United Nations Conference on Trade and Development, a ranking that most experts believe will increase along with China's growing economic stature. China's almost $80 billion of outbound FDI in 2012 equaled roughly 1% of China's 2012 GDP. While this is China's largest historical outbound FDI percentage, it remains far below the averages of other G20 countries and the OECD in 2011, which were 2% and 2.8% of GDP, respectively. There is considerable growth potential. Looking at outbound FDI stock, according to the United Nations, China's OFDI stock in 2011 was approximately $365 billion, or about 5% of their 2011 GDP. According to the Wilson Center's 2011 report, An American Open Door, the average transitional economy maintains an outbound FDI stock equal to 15% of GDP. For China's outbound FDI stock to represent 15% of China's 2011 GDP, it would have to equal approximately $1.1 trillion, roughly triple what it is today. It will take some time for China to catch up, but the momentum is there. Unless 15% sound outlandish, please note that the average G20 economy maintains an OFDI stock equal to 26.4% of GDP. There's a lot of room for growth. As to future potential, Standard Chartered has forecast China's 2020 GDP at $24.6 trillion. While we don't endorse any specific forecast, based on Standard Chartered's estimate and the average transitional economy outbound FDI stock of 15% of GDP, China's outbound FDI stock could grow to $3.7 trillion worldwide. An astounding number for sure, but still $800 billion less than the U.S. outbound FDI stock in 2011, which was generated on U.S. GDP that was 40% lower than Standard Chartered's forecast for 2020. So, how much of China's outbound FDI will come to the U.S.? Historically, the U.S. has been the world's largest recipient of global FDI at 17%, 3 times larger than the next largest recipient. While China's historical direct investment in the U.S. has not moved the needle, in 2012, as reported by Dr. Scissors, 40% of China's non-bond investment was in North America, with over $14 billion coming to the U.S. We may indeed have entered a new era. To illustrate the potential, if China's economy grows as forecast by Standard Chartered, and China's outbound FDI as a percentage of GDP equals the transitional economy average of 15%, and the U.S. receives 17% of China's outbound FDI, then we're looking at a market potential of $620 billion. That's enough to move anyone's needle. And interestingly, is about 1/2 of the $1.2 trillion position that China currently holds in U.S. treasuries. In June 2011, the President's Council of Economic Advisors published a report on the importance of inbound FDI to the U.S. economy. It is very revealing. In 2008, the U.S. majority-owned affiliates of foreign companies employed 5.7 million U.S. workers, paid compensation that averaged more than $71,000 per U.S. employee in 2008, 31% higher than the overall U.S. average at the time, owned $11.7 trillion in U.S. assets, generated $35 trillion in annual sales, invested $188 billion in capital expenditures, invested $40.5 billion in R&D, and were the source of 18.1% of U.S. exports. By executive order in June 2011, the President created Select USA under the U.S. Commercial Service to specifically focus on attracting FDI to the U.S. In creating Select USA, President Obama stated, and I paraphrase, "Business investment in the United States by foreign firms is a major engine of economic growth and job creation. My administration is committed to enhancing the efforts of the United States to win the global competition for business investment by leveraging our advantages as the premier business location in the world." There are numerous push factors in China and pull factors in the U.S. that will drive dramatic growth in China OFDI to the U.S. in coming years. Push factors include China's decision to diversify over $3 trillion in foreign reserves, which, as mentioned before, includes $1.2 trillion in U.S. debt securities into hard assets. The $500 billion China Investment Corporation has 43.8% of their equity holdings in North America. The CIC is now targeting a 51% allocation of their portfolio to alternative investment strategies such as private equity, real estate, and infrastructure. And to the point of real estate, I spoke about 10 days ago at the annual China Business Conference at Columbia University. And one of the panelists on the real estate panel was Wang Shi, who's CEO of China's largest real estate developer. He's involved in a $620 million project in San Francisco. Moving on, the People's Bank of China is planning to create a $300 billion sovereign wealth fund, specifically targeting investments in the U.S. and Europe. And lastly, China has made a decision to invest in more advanced economies, which, of course, we saw occur in 2012. As to pull factors, there are many. In addition to Select USA mentioned above, the U.S. Commercial Service has a presence in China that is 3 times larger than the size of their presence in any other country. Some 30 states have 1 or more authorized trade offices in China, largely focused on FDI. At the local level, we saw Mayor Nutter's video regarding his December trip to China and his desire to attract Chinese investment to Philadelphia. While as mayor of the U.S. Conference of as president of the U.S. Conference of Mayors, Mayor Nutter is a leading voice. His desire to attract Chinese investment is shared by many across the country. There are many pull factors beyond government and other organizational efforts, but in the interest of time, I'll just mention 2 that are not typically part of FDI discussions. One is the availability of distressed assets in the U.S., including companies in bankruptcy and others who cannot attract the necessary capital to sustain or grow operations. While China's presence in the distressed asset space to date has been limited, we expect to see this grow substantially as investment vehicles emerge which allow Chinese investors to comfortably participate in this area, where the required transaction speed is inconsistent with the traditional pace of transactions involving Chinese investors. Certainly, the acquisition of battery maker A123 out of bankruptcy by Wansheng may be a harbinger of things to come. More on this noteworthy transaction in a minute. The other pull factor that I'll mention relates to the number of academically talented and highly motivated Chinese students being educated in the U.S., some of whom are in the room tonight. In the academic year 2011-2012, there were roughly 200,000 Chinese students being educated in the U.S., approximately double the number of students from the next largest source country, India. This represented an increase of 139% in just 4 years. Among the Chinese students in the U.S. were the children or grandchildren of 5 of the 9 members of the Politburo Standing Committee, the supreme decision-making body in China. To quote Ann Strock, U.S. Assistant Secretary of State for Education and Cultural Affairs, today's youth are tomorrow's leaders. International education creates strong, lasting relationships between the U.S. and emerging leaders worldwide. We agree and believe this is surely a leading indicator. So, why do we believe that the U.S. renewable energy and clean technology sectors are positioned to be significant beneficiaries? Our reason for optimism for this thesis starts with the goals set forth in China's 12th five-year plan, which emphasizes 7 strategic emerging industries of particular social and economic importance through 2015 and beyond. The 7 SEIs are targeted to receive investment of $1.7 trillion during the 5-year plan, and 3 of the SEIs are in sustainability. China's 12th five-year plan sets goals across the environmental landscape, which have been described by many as the most ambitious in the world. From a future economic standpoint, China has targeted the SEIs to be profound contributors to GDP, growing from approximately 2% last year to 8% in 2015 and 15% in 2020. Assuming Standard Chartered's projection of China's 2020 GDP, we're looking at an aggregate SEI contribution to China's 2020 GDP in excess of $3 trillion. Again, we're not making a specific forecast, just intending to make the case for substantial growth. So why does this outflow of Chinese investment capital present an opportunity for the U.S. industry stakeholders? Well, first I'll distinguish between investments in greenfield projects and M&A. In greenfield projects, renewable energy has been the world's leading recipient of global FDI, garnering $91 billion, or 11% of global FDI in 2011. And the United States is the #1 country receiving FDI for renewable energy projects. In 2011, the U.S. received 11% of total global FDI targeted to the sector. In 2011, China emerged as one of the top 10 global providers of FDI to renewable energy projects. Given China's growing outbound FDI and their prowess in renewable energy manufacturing, it seems likely that the coming years will see substantial China outbound FDI to this sector. The now expired 1603 grant provided $11.6 billion of funding to more than 37,000 projects from 2009 through May of 2012. As Joe Salvatore will illustrate later, there's a large funding gap. In the realm of corporate M&A, it has been reported that 36% of worldwide clean tech companies are in the U.S., approximately 7,000 companies. But much more importantly from our view is the percentage of professionally sponsored clean tech companies that are in the U.S. In this regard, the percentage is much higher. We define a company as professionally sponsored if they've received equity investment by a venture capital, private equity, or corporate investor. In other words, a company whose technology and management has been vetted by third-party investors and which has received an investment from one or more of them. Based on our internal database called the Portfolio Enhancement Database, there are approximately 1,050 professionally sponsored clean tech companies, of which 58% are located in the U.S. We believe that many of these companies are prime candidates to attract investment capital and acquisition interest from China. As reflected above, these companies all fall within each of the 3 sustainability-focused SEIs, plus a 4th, advanced materials. We've seen the market for venture capital investing in U.S. clean tech dry up considerably over the last 2 to 3 years. Most of the domestic interest is on the project side, so-called downstream investing, very little upstream. And many of the investments in clean tech companies came from funds that are nearing the end of their life and are facing liquidity challenges as IPO and other exits have been difficult to achieve. A number of these portfolio holdings would qualify as distressed assets. While Joe will speak to this in more detail, we see tremendous need for both investment capital and viable M&A exits in the sector. Of course, the opportunity for domestic companies to receive investment capital and gain access to the market in China could be very attractive. Now, I admit that as we've developed our cross-border business initiatives at GreenWorld, I drank a lot of Kool-Aid. So, where are the flies in the ointment? What can derail this compelling growth story? Well, one of the most visible is the Committee on Foreign Investment in the United States, or CFIUS. While Derek will speak about CFIUS in more detail shortly, I will add a brief comment about Wanchang's recent acquisition of A123 out of bankruptcy. The transaction received significant political opposition, but Wanchang offered more than twice the $125 million bid of Johnson Controls. So, after some lobbying by A123's creditors, the $256 million transaction received CFIUS approval after the parties agreed to exclude a $2.6 million military contract, approximately 1% of the transaction value. Now, given the volume of transactions that we anticipate, there will surely be transactions that fail to receive CFIUS approval. However, with careful planning and the use of knowledgeable advisors, with some negotiation, I believe the vast majority of transactions will receive CFIUS approval. In conclusion, we believe that Chinese outbound FDI will provide a much-needed source of capital for the U.S. industry stakeholders in both the public and private sectors. In addition to providing attractive investment returns to Chinese investors, this capital could accelerate deployment of renewable energy and clean technology projects in the U.S., preserve and create U.S. jobs, and facilitate U.S. companies' access to the large Chinese market. Thank you.
First things first. Can you guys hear me okay?
Great.
I need to wander when I speak. You know, some people need to use their hands. I need to use my hands and my feet. So I'd rather not be stuck in front of a microphone. So I'm here basically because Heritage has said, well, I started this in about 2001, and then Heritage sponsored it when I started working there. We have a public database on Chinese outward investment, transaction by transaction. When I started it, there were no others. Now there are others. Some of them just copy us. They appear a couple weeks later. Exactly the same transactions. And then NDRC put out one that was so laughable that they don't make it publicly available anymore. There are other estimates of Chinese outward investment by country, by field, and aggregate. As far as I know, we have the only one that actually gives you the transactions. And what that means, of course, is that there are mistakes in it. And I would love for you to look it up and tell me where we think their mistakes are, because that's how things get better. That's why you make them public. So an advertisement, it starts in 2005. Limitations, it's $100 million and up. All that good news for a lot of people in the world that David just gave you is terrible news for me. When I started in 2005, I had 12 transactions that constituted the entire year's list. Last year it was 104. It's just going to go up and up and up and up and up, right? So it's this nightmare he just laid out for me, where I had to track 1,000 transactions in 2020. Please help me. If there's stuff that we got wrong, there's stuff you see coming, please come and take my card. I love the help. We're trying to do a public service. This database is used by academic researchers all over the world because it is public and you can decide what you like and what you don't like. It does have limitations. I'd be happy to tell you about them. Let's see. We're missing some small alternative energy investments. I'm not going to worry about any of the other limitations. So I want to talk about China's outward investment according to our database. And on our calculation, and you saw MOFCOM agrees, we put our numbers out before MOFCOM, so we obviously don't copy them. They don't minimize the transactions, so I don't know where they're getting their numbers from. And we count differently than they do, and yet somehow their numbers are always very much like ours, which I just find very odd. And in fact, I do have people calling me from Beijing and saying, you know, could you tell me how to do this? Because I don't think they actually know at the moment how best to count their numbers. Both MOFCOM and we had last year being a record for outward investment globally. A lot of this is timing. Do you time a transaction? Do you say it's done when both parties have agreed inside the contract? Do you time it when the money is all spent? So some people might have this year as the record for Chinese outward investment and not last year. We may have a downturn this year because this year had a big political interruption in the past month due to the National People's Congress, where everybody was in Beijing and they weren't making deals. So we might actually see a downturn this year, and that's the general point here. There are going to be ups and downs. That's normal. The idea when people sell you, which David certainly did not do, people sell you a bill of goods that says this is going to always rise and every year is going to be an increase. That's not what our data show. That's not what MOFCOM data show, and that's not normal. So if 2013 is a down year, that doesn't change the story. It just happens to be that there was a lot of investment last year, and we lost like a month worth of investment activity this year. And 2014 will bounce back. I'm not saying 2013 will be a down year. I'm just saying it's perfectly plausible that it will be. It doesn't change anything that people are talking about here. We have included in the tracker 100 transactions, just reached 100 at the end of last year. It's updated twice annually. Worth over $200 billion that we call troubled, meaning that over $200 billion is lost money. It's either money that was blown on cost overruns, it's transactions that were blocked, various kinds of troubled transactions. So we see the potential of Chinese outward investment being larger than we've actually seen it. We also know that there's going to be trouble. David just ended with this. There's going to be trouble going forward. There will be more failures. There will be big, high-profile failures where some country acts unfriendly, or the Chinese company blows it, or there's fraud. We just had the chairman of Sichuan Hanglong get arrested for harboring his brother who's accused of murder, and then blew up a number of international transactions. That's going to happen again 3 years from now, 4 years from now, whatever. It doesn't change the secular trend. So what we're seeing in Chinese outward investment is not, there are some people out there talking about $2 trillion in 5 years. That's not the point. The point is it's going to continue to rise. The point is we see what the upper limits are here, and even out 10 years, and they're very large. They're much larger than where we are now. So I would be surprised if annual Chinese outbound investment, which was about $80 billion last year, isn't $100 billion in 4 years. Now, maybe it'll be $100 billion in 2 years. Maybe. But that is a little fast. $100 billion annually in 4 years wouldn't be fast. That would be perfectly normal, and then it'll be $110 billion, then it'll be $115 billion, and this is just going to go on and on and on. There are a lot of young people in the room. If you're older, maybe the next 5 years is your timeline. The next 5 years could be choppy, but if you're looking out 20 years, this is a guaranteed growth market on commercial rates. So that's the overall trend for Chinese outward investment. For the U.S., is actually arguably better. Last year was shattered, on our counting, the record for Chinese investment in the U.S. The previous year was 2007. 2007 was all finance. It was right before the financial crisis. That didn't work out too well. So there was a slump after that. But there was a big bounce back last year. Much more diversification. Last year was by far the best year, not only in terms of volume, but in diversification for Chinese investment in the U.S. If you look at the history, and I want to talk about this for a second, I don't want to take up much of your time. I like Q&A a lot better than presentation. The start of Chinese outward investment is actually an investment in an American company. It's Legend, now Lenovo, buying IBM's personal computer unit at the end of 2004, the beginning of 2005. That's the change. I was in business at that time. All these Chinese